Hello, welcome to the Bloomberg Intelligence Industrial Call. I'm your host, Christina Feehery.
Hi, I am Mustafa Okur. I cover electrical equipment and flow control companies.
I'm Karen Ubelhart. I cover large cap industrials, U.S.
And Chris Ciolino, I cover U.S. machinery.
So last time we spoke, we were eagerly awaiting the second quarter earnings for the industrial sector. Now that earnings season is behind us, let's discuss how everything shook out. I think one major theme we saw across the board was that there was some customer destocking happening. Mustafa, can you weigh in on how this impacted your coverage?
Sure. So I'll start with the electrical equipment side, and the big surprise there came from Rockwell Automation. It seems like the more exposure you have to discrete automation and the higher exposure you have to distributors, the more impactful was the destocking throughout the quarter. And we're seeing this in orders, right? So not in sales and earnings yet. Companies have massive backlogs that will keep feeding the earnings for the rest of the year. But the orders are starting to climb down, it seems. And in the case of Rockwell, management's guidance for orders tend to be a little bit sporadic, but they did mention that they're expecting the destocking to continue into the next two quarters, but there is a bit of expectation around recovery in 2024, and they're seeing this across the spectrum in their distributors and also machine builders, so OEMs as well. I guess Karen could also chip in here, but we didn't see that phenomenon repeat when Emerson reported a few days later. They're more process exposed. They have more direct sales to their customers. In fact, the ratio seems to be sort of the opposite of Rockwell. So Rockwell is around 80% distributor go-to-market, and then it's around 20% for Emerson. So that's the big takeaway. As I said, they are coalescing around a 2024 recovery. Cognex also in a similar situation. They're expecting warehouse automation to remain weak for the rest of the year. But then we had Siemens reporting very recently, and they said they are expecting weak orders well into 2024. Key difference there between the US industrials, I would say, is they have much higher exposure to China. China is only 6% of Rockwell sales, for example. So there is a lot of weakness there that is driving the order decline for Siemens. So I'll note the difference there. And there is some destocking across the other companies as well. There is Hubble, for example. Now that they have more chips, their smart meters backlog is coming down. But we're not seeing this across the broader electrical equipment sector. Like Eaton continue to build their backlog. Amatec also another quarter of backlog building. So it's been a bit of a mixed bag for results, but there is an emerging theme of destocking. I'll stop there. I'll get into flow later, but I'll give the floor to other people.
The biggest commentary on destocking was really on the HVAC side, which Christina is going to talk about. Parker has one of the biggest exposures on the distributor side, and we didn't really hear much about destocking. But and backlogs were a mixed bag for these guys. But we mentioned Emerson earlier, and their backlog was actually up double digits year over year, with better than expected revenue as they were able to push more out the door. So, and as Mustafa said, very little of their business is through the distribution network. So, you want to go on to HVAC?
Yeah, sure. So the HVAC companies like Trane, Johnson Controls, and Carrier all cited customer destocking mostly in their residential business. This is something we expected already at the start of this year because the residential side is impacted by consumer demand, and that's weakening, and also it had such a big boom during the pandemic. In terms of orders for the HVAC companies, also orders are down, but again, they've had such elevated backlogs in the past couple of years that It's really not a concern. It's just more of a normalization, and it's more just noise in the market right now, trying to get back to pre-pandemic timing, so to speak. Chris, how about your side of the market?
Yeah, I'd say the one side where we did see some destocking was on the industrial distributors. Again, very short cycle, good real-time indicator for industrial manufacturing economy. And I'd say the biggest destocking was at Wesco, which had a pretty pronounced impact on results. They had probably the most disappointing quarter out of our universe. And combination of slowing demand on top of some destocking, really driving the underperformance there. But if you think about machinery in general, no. In fact, we actually saw restocking at Caterpillar. They added, I think, roughly 600 million to dealer inventories in 2Q, which was roughly $1 billion tailwind to sales. So that was unexpected. And I think expectations now for the balance of the year have kind of been reset. Dealers were expected to kind of maintain dealer inventory levels on par with 2022. Now it seems that dealers are going to increase inventories and will be slightly above last year's levels. They will destock for the rest of the year, particularly if you look at excavators, inventories are too high there. So we would expect some destocking to occur over the balance of the year.
Great, and I know we all kind of touched about orders and backlogs, but let's dig a little deeper into that with the destocking. How is this impacting order rates, backlogs, maybe outlooks, like Chris mentioned, for going into next year?
Sure, I can start there maybe. And what we saw at the peak of the supply chain shortage for the electricals was 50% coverage of annual sales, right? So half of the annual sales of the companies, roughly speaking, and this holds true for Rockwell, for Amatec, for Eaton potentially as well. 50% of the sales were in the backlog, right? So that has started to come down in the case of Rockwell, not in the case of Eaton. But the idea or the expectation is that we will keep climbing down as the supply chain continues to improve, because the distributors and OEMs, like the machine builders, they don't need to place as large orders as far out, right? Because the expectation is that instead of getting their parts in 30 weeks, they will get their parts in 12 weeks, still slightly elevated from the 6 to 8 weeks that you usually have, but much better than what we had last year, right? So that's the overarching trend, and that normalization will take probably into 2025 for most of my companies. And in the case of, again, some of the big diversified electricals like Eaton, Hubbell, maybe that takes a bit longer because they're exposed to structural tailwinds from the infrastructure projects, from data centers, from the recovery in aerospace. So that could even be longer. And I think the idea again is to not to go back to the previous level of coverage. So in the past, the backlog was maybe 20% of annual sales. I mean, Rockwell was pretty much a book-to-ship business intra-quarter, except their project businesses, the life cycle segment. So I don't think we're going back to those levels of coverage. We'll still be elevated, even probably entering 2025.
I know
Yeah,
for
I'm
the
happy
HVAC
to
companies.
I'm happy to
Sorry.
jump in. I think that was one of the surprises for me this quarter was that, backlog and orders held up a little better than I expected. I really kind of anticipated to see more pronounced declines in orders along with peaking backlogs, but that really wasn't necessarily the case. Cat, again, for example, orders strengthened in 2Q. The backlog actually improved slightly quarter over quarter. Now, most of that was price, but was kind of expecting that to, moderate or come down a little bit. And even in cases where we did see backlogs come down, like Terex, Oshkosh, Terex backlog was down 10%, but it seems like a larger driver of that was really a function of the supply chain improving and just ability to get product out the door, not necessarily a deteriorating demand environment. So again, something that we'll certainly watch closely here over the next few months, as the macro indicators continue to suggest a slowdown, but it just really hasn't, materialized yet. And we still have, very extended backlogs and well over $1 billion worth of orders already slotted for 2024. So certainly an encouraging sign, at least for the first half of next year.
I would say a number of my companies expect their backlogs to continue to come off a little bit in the second half, but they'll still be at record levels, and most of them do not think that they'll get entirely rid of their excess backlog. That was the result of the supply chain issues by year end. So they will enter 2024 with, in many cases, still a record backlog. And on the one signal for me on what the second half is going to look like is Parker Hannifin, which is 70% distribution, and they did not, and their orders in North America did slow quite a bit, down 8% year over year, and they were down 4% in the prior quarter. So that part of their business is very tied to industrial production. So that's telling you something about, the North America short cycle business. Aerospace, of course, was great, and they still have a good story on 24 just because of aerospace and their execution. So not particularly worried about them. But
Was that down 8%, Karen?
down 8%, yes.
So it accelerated from the first quarter.
Yes, from well, and their fiscal, so that was their fourth quarter, but fiscal third quarter was down 4% in both U.S. and international, and then 8% in North America in the last quarter and 1% in international. And I will say shipments exceeded expectations, but that's because they're not a backlog business. But because of what was going on with supply chain, they have a backlog, and so they just shipped their backlog at a faster pace than they expected.
Yeah, sounds like similar to some of mine. But on the other hand, in flow control, for example, I had the opposite of that trend, whereby Xylem, for example, the orders declined at a slower pace compared to Q1. So I would say underlying demand mostly holding. So volumes are still holding, even though whatever growth we have now is mostly pricing. So just an anecdote there on the orders.
Yep, and then in the HVAC sector as well, I would say the underlying demand's still there. All the companies had about 6 to 11% organic sales growth, even though their backlogs are still high and their order rates were declining. Trane's backlogs, probably majority of it is commercial HVAC, which is helping all of this demand. They're all more tilted towards the commercial space, which is helping as residential is declining. So I know we just talked a lot about the top line. How about profits? What's going on the bottom line? How's everything holding up there for your coverage?
I mean, I didn't see a whole lot of large beats. Most of the some of them did beat big, but didn't raise big. So you can see the hedge on the second half still. And the ones that did beat big, frankly, I would characterize that as execution. I mean, 3M, which has struggled for a while, has done a big restructuring program. It's still underway, and they saw, they beat big on the margin side. Emerson also beat. Now they had better than expected volume, but it was also margins were through the roof. But but none of them raised really big. And so they're all still putting in a hedge on the second half. Fortive beat, that was also, execution. So you're seeing more of the companies that beat expectations, particularly on the top line. Either we're able to get more stuff out the door than they expected, so a number of them exceeded on the top line, or good execution on the margin side. So I had 3 or 4 of companies that beat big on the latter basis.
Yeah, I mean, machinery, just in general, I'd say U.S. machinery results were better than we expected, with the overwhelming majority of companies we follow beating both on the top and bottom line. And I think even probably more surprisingly, I think we had like 60% of companies raise their outlooks for the year, on the heels of already, very strong 1Q performance where essentially everybody beat and raised. So very solid performance in aggregate. We saw machinery companies beat, I think, by about 5% on average on the top line, but nearly 25 to 30% on the bottom line again, which was very similar to 1Q. Actually, I think it was almost identical. I think we only had one company miss on the top line, which was C&H, which appears to be more company-specific issues, and only one miss on the bottom line. We anticipated the strong performance in 2Q, just maybe not at quite the same level of outperformance as the first quarter. And I'd say the construction equipment producers, I think, were the real standout this quarter, and posted the strongest outperformance. So Caterpillar, Terex, Oshkosh, Manitowoc all beat across the board and raised guidance. And very similar to Karen's names, I think the single biggest driver of the outperformance was the execution and operating leverage, simply because factories were able to run more efficiently. We saw fewer supply disruptions, and they were able to get more product out the door. There was a slight moderation in costs, more freight, logistics, some inputs easing a bit, but really when you combine that with the higher volumes that we saw, and still what's a pretty strong pricing environment, you got pretty impressive operating leverage with 30, 40, 50% plus incrementals in many cases. And margins actually accelerated sequentially for a number of my names, which we weren't necessarily anticipating. And I'd say despite the strong 2Q performance, the reaction the shares was kind of muted this quarter. Really kind of almost unchanged following results on average across our universe, with more strength, like I said, on the construction side. They had some slight outperformance, whereas ag and trucks were a little bit sold off after the numbers. But I think investors were broadly anticipating strong results, and I think this maybe kind of makes us a little bit increasingly cautious that earnings are rapidly approaching a peak here. Factories are running, near capacity, growth rates, margins, earnings, all going to moderate here in the back half of the year. So this first half performance we saw, probably not sustainable, but again, on the whole, very strong 2Q results for the group.
Chris, you said they largely raised. Did they raise by just the second quarter, or did they raise the second half?
No, these were true beats and raises by more than the 2Q beats. With I'd really probably highlight Terex and Oshkosh is really the two standouts in terms of just sheer magnitude of the 2Q beat and the raise. Now remember, these companies, aerial equipment producers, had been more adversely impacted by some of the supply chain disruptions. So they had kind of been like the last to recover from this. We saw trucks, build rates really have accelerated in the first half of the year. We're just starting to get out from a lot of the supply disruptions on the aerial side. So I think that really helped contribute to just the sheer magnitude of the beats here.
I mean, there's very limited I can add here. Basically, Karen and Chris covered it all, but just to drive the point home about expectations, both the electrical and the flow groups that I cover, they beat on average by around 12%. The average price change for the electricals on the day was 2%, and flow was flat. So I think there is a concern around peaking growth and margins, for the second half. But overall, just great execution. A lot of beats and raises after management feeling a little bit more confident about execution in the second half as well.
So if everything's good, where do you think, all those recessionary fears are overdone? Are we going to get out of this without a recession? What's your industrial outlook for maybe at the end of the year going into 2024?
Sure, I'm happy to kick this
Who wants
conversation
to make
off.
that call?
Um, I think the results this quarter probably suggests maybe 2024, at least for in the machinery world, ends up being probably a little more resilient than I probably had anticipated going into the quarter. Had a more of a bearish stance going into next year that we are at peak. I think underlying demand seems to be holding up a little bit better than, like I said, we anticipated. Production rates are going to slow in the back half of the year. Pricing is going to moderate pretty significantly as we lap these more difficult comps. Backlogs are going to come down. But probably more gradual easing than falling off a cliff. I think one thing that we'll watch closely are inventory levels. We continue to see both new and used inventory levels really across the machinery universe increase. So we'll watch that closely as what that exit rate looks like into at a 4Q, especially as supply continues to improve. And really, we hear most OEMs kind of targeting more normal seasonal patterns next year with the goal of producing in line with retail demand. We're kind of the belief that, volumes are flattish next year, broadly speaking. Pricing is going to be returned to more normalized levels, low single, mid-single digit growth. So I think next year ends up being more of a story on the cost side of the equation and how to manage the cost structure to still, protect margins in what could be a flat to slightly lower volume environment.
Chris, I would just point out on the rental equipment companies, which we have not talked about, their used equipment sales were like triple or quadruple what they were last year. So that is probably having an impact on the used equipment because they did not sell for the last years because they needed the equipment. Now they've accelerated playing catch up, trying to get a more normalized replacement cycle. And so they're dumping a lot of equipment. They aren't the whole sector, but they have an influence. So 2024, I think a lot of the companies are going to be entering the year with decent backlogs, as I said earlier. So I think at least up in the first half, we'll see some good growth. I'm of the camp that there'll be a slowdown and not an industrial recession. The one thing we haven't talked about is there's just so much money, federal money, that impacts a number of companies and a number of sectors in industrials, which I think is really going to help 2024 and is not really tied to the economic cycle. There's companies, of course, in my diversified universe that has consumer exposure, and they are seeing it and will likely continue to see slowdown next year. And I would say ITW and 3M are the biggest in my universe, but they are having a tougher time on the organic growth side, and that will probably continue rolling into next year. And also the HVAC guys, but that's really only in the resi business, and so I don't think that's going to have a material impact on 2024 for them.
I mean, I also have a diversified coverage, but I wouldn't agree with the statement that everything is good across the board, right? So we are seeing a big slowdown in the short cycle distributor exposed companies, namely Cognex and Rockwell Automation. But a lot of the coverage is well diversified, and they are exposed to the structural tailwinds, partly which comes from the federal money that Karen highlighted, partly because we have this massive switch to electric vehicles, so there are a lot of greenfield and brownfield upgrades. That has helped Amphenol and T connectivity, for example. We saw that in the quarter because they're outperforming relatively weak automotive production rates across the globe. But yeah, overall, I also don't expect a massive sort of decline in the earnings or the sales of the companies that I cover There are edge cases like we highlighted. Cognex, they're a lot more exposed to short cycle, big exposure to warehouse automation, which has been weak for a couple of quarters now. Consumer electronics, which really peaked around COVID, that hasn't come back yet either. So there are edge cases, but I wouldn't say on the whole for electrical equipment or the small multis or the flow control companies, there doesn't seem to be a massive collapse in orders.
Any of your names express any optimism around China next year? I know, at least from my perspective, China took another leg down during the quarter, which we kind of saw coming. And at least from a machinery perspective, China's largest machinery market, it still seems pretty oversupplied. But I'm not hearing any signs of potential green shoots or stabilization yet. Just kind of curious if you guys are hearing anything.
Stabilization for the data center and market for me, which affects mostly Vertiv and partly Eaton. But other than that, I haven't seen any positive or neutral commentary. It's been negative mostly.
We're good.
Okay.
Okay.
Is there anything we've missed from the earnings? Big surprises, disappointments, anything you wanted to make sure investors know and understand?
GE was the blowout company this time as they get closer to their spin-off. Aerospace is just through the roof for every company, which we haven't really talked about. And, their aerospace was up over 20%. The margins were, excellent. And the big surprise was their renewable business, which is wind power. Orders are up 4 times. Volumes were up 27%. The consensus was up 5%. Margins were up 420 basis points in that business. That's been a terrible, terrible business. It's a less terrible business right now. I mean, the margins are still not good. The volumes are going to really, really help them, and all the restructuring they did as well. And anybody like Honeywell and Parker and GE that had aerospace, that's still a terrific story, and that's going to continue into next year. The other thing, lastly, is Honeywell, which did not really, they beat by 3 cents, they raised by 2 cents, and they always are a beat and raise modestly company, and so that was a highlight in the quarter because the stock was actually down 6% because they don't miss. I mean, they didn't miss, but they didn't raise, and that's an atypical pattern for Honeywell. So that was kind of a highlight in the quarter. But the big blowout was GE, and that stock, really performed well.
Aerospace seems to be still in the early innings of recovery. Would you agree, Karen?
Yeah, yes, yeah, I would. And, people are saying, look out for mix because, the OEM build rates are going up, but the margins are still really good because, the aftermarket business, as particularly now as international travel is picking up, that's still giving them terrific mid to high 20s margins in that business. So that's definitely got legs.
Yeah, and I think that will help cushion some of the slowdown in the more cyclical end markets going into the second half in 2024 for companies like Amatec, Eaton as well.
Yeah.
Great. Well, thank you everyone for your time. That's all we have today, and I really appreciate all your insights.